China's export can grow.
Almost 1.8% of the total equity, worth over 5,500 crore, exchange hands.
24,754 on the Nifty. The Nifty bank is absolutely flat.
The reduction recommended by the MPC is for 50 basis points.
This bigger than expected easing has lifted the market move.
Government is considering a PLI-like scheme for rare earth magnet manufacturing in the country.
So, should the market assume that the terminal rate can still go down after the pause?
Liquidity is abundant, and if we do not do any VRRR, then it's going to stay at 5.25.
The Nifty, Bank Nifty, the NBFC Pack, Fin Nifty, all of them very, very strong. It's like
Well, that's the day so far, and what a day it has been. I don't think very much needs to be said. You can just look at the screen and just sort of, gauge what's happened. 10:30, the rate decision essentially was the point where the market took off, went up like a rocket, and then it sort of kept going through the atmosphere, through the stratosphere and beyond, and I don't think it's come off very much. So we're at the day's highest point. The Nifty Bank, of course, making a new record high. And broader markets also not really being left behind. Lots of sectoral gainers, banks, financials, of course, top of the board, but real estate also doing very, very well. This is Closing Bell. We're coming to you from the CNBC-TV18 News Online studios. I'm Prashant, with me my colleagues Reema and Surabhi. Guys, hi, afternoon.
Hi, good afternoon. I don't know who gave the cue to whom, whether it was Reema to the Reserve Bank of India or Reserve Bank to Reema. Yeah, she read it. No one thought that we'll get the kind of bonanza that we did, right? On a lighter note, I was joking in the newsroom upstairs that maybe Donald Trump will feel if you could just call Governor Malhotra to the US, talk to Jerome Powell. See, this is how it's done, Jerome. But yeah, I mean, what a policy, and we'll talk about that as we go forward.
Indeed, and all the risk assets are up and about. So interest rate sensitive. So whether it's Realty, the Realty index is up 4.5%. Banks are doing well. So banks have a gain of close to about 1.5%. Capital market players are active. Auto is up and about. There's no complaint in this market. Everything's green. There are just a handful of stocks in the red.
Yeah, no, absolutely. And, so, yeah, 25, basically the market's now 25,116. That is, and you're almost there. I mean, of course, it needed a little bit of help from the Reserve Bank, but it got it. So 25,116 is the next resistance, which is nothing but the high that we saw on the 15th of May. That's it. And, let's see if you're able to get to it. Not today. I mean, I think 260 is good for today, but I think between now and the all-time high, 25,116. Let's see if this is the trigger which is needed for the market to take out the range, which it has been with 463 on the downside and 25,116 on the upside. Real estate index is up 4.7%. DLF, last I checked, was up 6. Godrej Properties is up sharply. Capital markets is another index which is up 2.5%. So Nifty Realty, Nifty Capital Markets, and maybe you look at of course, the private bank index, which is up about 2% as well. Metals are higher, about 1.9%. Autos are up 1.5%. I mean, it's the economy and that aggressive rate cut, hoping that maybe demand, it'll help spur demand, which has been rather poor, subdued in many segments, especially in the lower end of the marketplace.
Prashant, I remember in Bazaar you were saying that how is it going to be? RBI is going to be the second headline today.
No, it's the first.
And then the RBI said, hey, never discount the central bank, right? But just to talk about the global cues as well, we are seeing this beautiful rally play out on our screens. And there is fresh ammunition in terms of international positioning right now. US futures are up and about. Remember, today is the all-important non-farm payrolls report as well. So unless there's a massive disappointment or a howler there, the expectation is 125,000 jobs should be added in the US economy in the month of May. And right now the market's going in with the positive expectations for that as well. So it's local plus it's global. It's turning out to be a good Friday.
So how should you position yourself for the last hour of trade? 1 hour to go to wrap up the day and the week. Ashish Kal from Wave Strategy Advisors is with us on the show now with a few closing trades. Ashish.
Hi. Afternoon to you and all the viewers. It has been a fantastic day. And what a surprise by RBI governor with the 50 basis point cut and across the board. Having said that, I think markets were waiting and consolidating for nearly around 12, 13 trading sessions, just in a very narrow range. And it has given a very strong breakout in today's session. Having said that, stock-specific action will continue. I think the interest-sensitive sector is going to be buzzing from here on. The first pick is going to be PNB Housing Finance. We can clearly see a very strong candle form today, bounce back from its 20 DMA. Huge volumes picking up there, and the stock can move towards the level of 1200 on the upside. And on the downside, the support for the stock is going to be around the Bajaj Housing Finance. We can clearly see a very strong move in one can create long positions here. Expectation is that the stock can go towards the level of 135, and on the downside, 120 is going to be an important support for the stock.
Okay. All right, Ashish, got that. Thanks very much for the strategies. We will come back to you in a bit for more question and answers. In the meantime, now let's address, of course, the big story of the hour and just a very quick summary of what's happened today and why is this such an important RBI policy, because the RBI has defied all expectations. You know, the near consensus on the street was 25 basis points. We got 50 basis points on the repo rate, but it didn't end there. No one was talking about a CRR cut, but guess what the RBI did? Not 25, not 50, not 75, 100 basis points of a CRR cut. And the sense is very clear that the easing has been front-loaded. And this was also adequately captured in the commentary that came in after the announcements, where the RBI governor said that the stance has been now changed from accommodative to neutral, because the MPC feels that it doesn't have any more elbow room left after today's cuts to do more on the rate front. And the RBI went on to say that the Reserve Bank feels that the war against inflation has been won. Remember, the inflation projections have also been lowered for the current year from 4% to 3.7%. There are a slew of other very important measures, including, of course, easier norms for gold loans below 2.5 lakh rupees. There was commentary on IndusInd and what's happening with that bank, commentary on what happens with foreigners owning bigger stakes in Indian banks. So we'll get to all of that bit by bit. But let's start by listening into the governor on the big rate announcements and the monetary steps taken today.
After having reduced the policy repo rate by 100 basis points in quick succession since February 2025, the Monetary Policy Committee also felt that under the present circumstances, monetary policy is now left with very limited space to support growth. Hence, the MPC also decided to change the stance from accommodative to neutral. From here onwards, the MPC will be carefully assessing the incoming data and the evolving outlook to chart out the future course of monetary policy in order to strike the right growth-inflation balance.
Okay, so that's on the policy itself. And then, of course, journalists also quizzed the RBI governor and the deputy governors on the latest with IndusInd and whether the RBI is satisfied with the manner in which things are progressing. Hear out what the governor had to say on this.
I think, see, the MD CEO, has resigned, and it says, for taking, moral responsibilities. So I thought, that should be good enough. Do you expect that all the board members? I mean, what are you hinting at? I think the MD CEO, who's also a member of the board, if he has taken responsibility, that is at the board level itself.
Okay, well, sort of slightly sharp exchange there on IndusInd Bank specifically. We'll get a comment in on what the stock, what it means for the stock, if anything at all. But before that, let's just also get the gold loan bit, because that indication came from Delhi. And I think it's been followed through from the Reserve Bank of India. So these are meaningful relaxations which have come through. Ritu is here with what's happened. Ritu.
Well, Prashant, first, overall for the sector, falling interest rates are never good for banks. It affects their margins. But that said, most of the bankers we've been speaking to have been talking about somewhat of a turnaround by the third quarter as liabilities also balance. For NBFCs, of course, this is good because the cost of borrowing comes down. But for gold loan lenders in particular, there is lots to cheer for because the draft rules which had come out were already much easier than what the street had feared. And now further relaxations have been announced by the Reserve Bank of India. What are these relaxations? To begin with, the loan-to-value cap for small ticket loans of up to 2.5 lakh rupees has been relaxed from 75% earlier to 85% now, which essentially means if the gold, for instance, is valued at 1 lakh rupees, earlier lenders could give a loan of up to 75,000 rupees, which has now been extended to up to 85,000 rupees. But important to keep in mind, they should also include the interest component along with the principal. So that LTV has to be maintained throughout the tenure of the loan. The second relaxation is that for small ticket borrowers of up to 2.5 lakh, in general, they will be exempted from any sort of additional credit appraisals to make it a lot easier for lenders to lend to this category of borrowers. And as far as the use of gold loans for commercial users is concerned, the end use monitoring will only apply for those gold loans that are taken under the priority sector lending. So a slew of relaxations being announced for gold loan financiers. Yes, as you rightly pointed out, the North Block very clearly making recommendations that small borrowers of up to 2 lakh should be exempt from these stringent requirements, and the Reserve Bank of India has followed through on how the biggest gold loan lenders, I mean, the likes of Muthoot, for instance, where almost 95% of the book is gold loans and nearly half of the book is to small ticket borrowers. These lenders stand to benefit significantly. They can extend more loans. This will boost loan disbursements. This will attract more borrowers and, of course, improve their earnings at the back of this. And then Manappuram, CSB, City Union and IFL are some of the other lenders that will, benefit from this.
Okay, all right. And a lot of those stocks are rising exactly for that reason. Ritu, thank you very much for, all the context over there. There you go, a rally between 5% to 6.5% on the key gold financiers. Let's take this forward with Prakash Diwan, who's joining us on this leg of the show. Prakash, hi. The RBI governor has ensured indeed it's a happy Friday for the street, right? So I have to discuss, trades across financials. But let's start with the gold loan companies, Muthoot, Manappuram. Would you buy anything after today's announcements?
Good afternoon, Sabi. So I think Muthoot, post the numbers itself, was looking so promising. You didn't need this particular, tailwinds to kind of back things the way they're growing. And my sense is you'd rather be better off focusing on some of the other smaller banks that are now going to be in a position to actively lend gold loans. Gold loans is a portfolio that's much easier for most banks. They really don't have to worry about, the risk weights. And it's self-fulfilling in that sense. So, there's no reason why the other banks, the banks that have already been doing a lot of this work, and I can tell you South Indian Bank, City Union Bank, there are lots of them who are, including SBI for that matter. Let's not talk about just small banks, but this is a segment that's growing phenomenally. But raising the LTV to 85 is always fraught with risk. Gold is at elevated levels. If something goes wrong on the valuation itself, you'll probably have the value itself coming down, and that becomes a bit of a risk management challenge. So the seasoned players are the ones you should go with. But I don't buy these things on the day where you're celebrating. Today, it's a day where defense is sulking, and that's the time to look at some of the defense stocks. Gold loans, NBFCs, financials, they probably look after a couple of days, maybe sometime next week when all this enthusiasm peters out.
And these gold financiers, I'm just checking, so far this year, they've actually done pretty okay. Manappuram is up 31%, 15% on Muthoot, when the market has been struggling in a range. Very quickly, Prakash, since we're talking policy, what would be your other, best picks just to play this liquidity and this, rate transmission, spree? Any bank, any NBFC stock that you'd go with?
Not really. See, I'll tell you the RBI policy, and it's been discussed. Ritu had a full house discussing it post the presser. So I don't want to, add to that or be repetitive. But what stands out is that the front loading of the easing is with the confidence that the transmission will happen very quickly, right? And that's why you also have the CRR cut giving you that backup. And the accommodative style moving to neutral is precisely because of that. There's no more pampering that banks need or financial services companies need. You better do that yourself and quickly, brace yourself up to this reality of reducing interest rates. How this benefits is the biggest beneficiary in the second order effect is not going to be just NBFC, it's going to be cement companies. I'll tell you why. We spoke to you must have heard the conversation between Mahindra Lifespaces and Signature Global, and all of them are talking about being able to expand the balance sheet much more aggressively. All these months, there's been no land parcel acquisition, except for some of the big names. and that was under JDAs, right? So if this were to happen, you will probably have a seeding of a lot of greenfield projects, and when that happens, immediately with a lag, cement companies do well. So I know it's like a little bit of a indirect way to look at things, but I would believe that this will cascade into benefits where cement sales will start picking up, the pricing will come back because real estate is doing well, because funding is better. So that's the way to kind of look at it. But today, it's a day worth celebrating. We didn't expect this; it's come as a surprise, so we should enjoy that. But I would believe going forward, some of the largest cement companies which have done well in terms of capacity augmentation, cost control, efficiency, they will sparkle brilliantly.
Got that. For today, the real estate companies are doing well. So the first order impact is visible in Godrej Properties, DLF, Prestige. These stocks are up between 6 to 7%. But let's focus now on a CNBC-TV18 exclusive. Sources tell CNBC-TV18 the Road Ministry is considering hiking motor third-party premium for FY26. Yash joins in with the details.
Well, this is a very important development for all the general insurance companies. What we've picked up from our sources is that the Road Ministry is considering a proposal which was sent by the insurance regulator IRDAI when it comes to hiking motor third-party insurance premium. Of course, under motor insurance, there are three important segments: motor own damage, motor third-party and motor personal accident. Motor third-party is mandatory to be bought with every vehicle as per the law. Now, as far as the price revision is concerned, it's regulated by, of course, the Ministry of Road Transport and the insurance regulator. And there hasn't been an increase in the premium for motor third-party premiums for about 4 years. The industry has been wanting it. Every year there has been a presentation which has been made by the industry, but there has been no movement as far as that premium increase is concerned. This time, there is a possibility that things could be different. The regulator sent a proposal asking for an average of 18% increase when it comes to motor third-party insurance premium. In fact, one of the vehicle categories, of course, in motor segment, has been asked for about 22 to 25% increase when it comes to that motor third-party insurance premium. Now, it's an important segment. I mean, it's a big business segment for insurance companies. About 20% of the total premium collected by the general insurance industry comes from motor third party. Out of the motor segment, it's 60% coming from motor third party. The loss ratios have been increasing because there has been no premium increase given by the government. But indeed, if it comes through this time about a 20% increase in motor third party insurance premium, that could lead to an improvement of about 4 to 5% when it comes to combined ratios for these general insurance companies.
That's an interesting story there. Yash, by the way, what is the tagline for the mutual fund, it's not mutual, the insurance campaign?
I mean, you're not wrong. The inspiration here has been the mutual fund industry. Mutual fund sahi hai is for, of course, the mutual fund industry. Acha kya insurance liya.
Acha kya insurance liya.
Yes, and I think they have very interesting the advertisements which they've made, which completely justify that tagline. Acha kya insurance kiya.
They need to get some cricket stars. I've not seen any cricket stars.
No, there's a dog and there's a cat, and they've been the brand ambassadors for this campaign. So,
all right, well, no, I see some of the billboards around here while driving in as well. Yash, thank you very much for that. ICICI Lombard is the big winner, 6%, and all of it, I think, after our story. Prakash, any thoughts here? Lombard or the others, Go Digit and the other general insurers, anything you like?
So I think it's a very important reset, and some of the players who are newer to the market will benefit without having to worry about the backlog. So let's say Go Digit comes to my mind. Again, it's not a specific recommendation, but if you had to kind of pick and choose something which probably does better than the rest, it'll probably be some of these names which don't have a backlog of claims that they've lost. I mean, the claim loss ratio that he's talking about, so that's something which you don't have to worry. The important thing, what it does is the third party insurance entry barrier going up or threshold going up actually is because there's a huge pre-owned market that's flourishing in India. In fact, it started about 3-4 years back, but it's getting more and more organized. So you have the car techs and the cars 24 and all of that. So what's important is that this segment is the one that usually wraps it up in the pricing itself. I mean, all cars which you buy out from any of these portals, any of these platforms, come with these insurance schemes, so insurance coverage. Now, that is something where, their margins will get impacted a bit, but the market will get much more cleaner and organized. So I think it is more, I would say it is more structural in terms of the salience rather than specific to some stocks. ICICI Lombard, of course, is reacting because it has the lion's share. And rightfully so, they'll not be bleeding out of this because 60% of their premium collection is on that. It's only the higher end cars that you have insurance, which is productive or very remunerative for most players. So I think it's structural, but I would believe a Go Digit will also benefit. Of course, it's not discussed much because it doesn't have a history yet post listing, but these are some of the names that will do better.
All right, Prakash. Great conversation as always. Thank you very much for joining us. Appreciate it here on CNBC TV18. So that's the bit which is coming through. So 250 odd points on the Nifty at this stage. We are at 25,000 basically. Let's go back to the big story, which is the Reserve Bank of India and what they've done. Lata, in the morning was telling us that, I think, Lata, you used the word fireworks. It is fireworks.
Yeah, absolutely.
See, Prashant in the morning was saying that RBI will be second story and Trump and all, Musk are the first story. No,
I think Malhotra heard it and decided to come back with a vengeance.
But I think we have the SBI chairman.
Yes, sir. Mr. Sethi, the SBI chairman is with us. Mr. Sethi, really grateful that you've pulled out time after, telling us that it is an extremely busy day for you. At first sight, what are your first views on the policy? You get a higher than expected rate cut. To be fair, your colleague Saumya was the only one who guessed it at 50 bips or forecast it. So congratulations on his behalf as well. But what are your first thoughts?
Thank you, Lata. I think on the rate front, obviously, we had some house view on that through Saumya. Probably, it was not as big a surprise for us as to the market. But CRR cut obviously pleasantly surprised every one of us. For a long time, we've been asking the RBI to have a relook at the CRR. And it's a good move in the sense that while the CRR mathematically does not impact any lending rates and deposit rates, it definitely augments the liquidity. And RBI has been providing sufficient liquidity, and also CRR will have reduction in CRR also will have a money multiplier impact.
Yes.
So that is a very positive in my view, and I hope that though the governor has given some disclaimer that they may always relook at it, but it will be a sustained one.
Yeah. So let me just explain money multiplier to those of our viewers who don't use these words on a daily basis. What the chairman is trying to tell us is that the CRR is not a one-time. What does it mean? 2.5 lakh crore of 1% of total bank deposits, which were lying at zero, at cash, can now be lent out at 8%, 7%, or whatever they choose to. It is not just that money that they make. The multiplier is every loan creates its own deposit. So whenever you go and ask for a loan, the SBI just creates a deposit in your name. And that deposit, they don't have to keep 4.5% as they used to last November. They have to set aside only 3% as cash. And again, you create more deposits. So this multiplier means, there is a fall in cost of funds for a sustained period, as long as the multiplier works. And I don't think that's very, easily understood by equity analysts, because this is not the daily thing. So I take your point on that, sir. Therefore, Mr. Sethi, would you say that loan growth you may have to relook? Because if you look at your November versus November CRR, last November 24, you were 4.5 CRR. And this November, you are going to be at 3% CRR. Would you say you may end the year with a higher than expected or higher than guided loan growth?
Obviously, in the last a few months, with the availability of liquidity obviously has never been a constraint for credit growth in the last few months. But the very fact that RBI further took steps in terms of increasing primary liquidity on a durable basis is something remarkable. So, and I'm sure that, which is the stance of the regulator is more towards propelling the growth. And we are sure, I think it's a no-brainer to expect retail growth to be more robust than what we have had seen in the last few months. I'm sure that will pick up. with the NMI, EMI, ratios getting improved. Two things. One is this rate cut, and the other one is that the tax rate cut, which is available up to 12 lakh rupees.
Yes.
We will be seeing some additional money in the hands of the people. So the NMI, EMI profiles of the retail borrowers is increasing, are improving. So which means that there definitely would be an improved growth in the retail. The question is the next question, before you ask, I'll answer that on the corporate credit growth. So I think we may have to see that the stage is set for availability of liquidity and a reasonable interest rate regime now. And it is for the corporates to take a call in terms of the investments. I'm sure some of the pipeline which we've had will get strengthened. And more importantly, Lata, the consumption coming back, both in terms of the housing loan-driven consumption, personal loan-driven consumption, may make everyone to look at their capex programs.
Okay. So more than capex, I want to get the margin picture, sir. Is it fair to say that your margins are going to fall in this quarter rather badly, but you will exit the year with much better margins?
I think we need to look at the Q4 exit margin, both the liquidity availability and the CRR cut. To a large extent, helps us to protect the margins. And as you also know, the incremental deposit rates are getting readjusted faster. The issue is only on the stock, and the stock will take about 6 to 9 months to meaningfully get repriced.
Yours is a large stock, sir, 30 lakh crore or something. So it'll take time. But if you could put some numbers, your U-shaped is very helpful. But how much does it fall and how much does it rise? I mean, 20 basis, 30 basis, how much do margins fall?
I mean, it's difficult to take give a number at this moment. So we'll also have to see how quickly we can transmit the deposit rates. And that will impact how deep is this U curve and how shallow it is.
Mr. Sethi, sir, good afternoon. Surabhi here. I just had one supplementary question to your point on growth. What was your expectation for the year, for SBI and for the system at large? And SBI is a giant part of the system. I mean, was it, some economists are saying earlier it was 9-10% credit growth expectation for this year. Now that gets bumped up to 12-13%. What is your assessment? And within that, unsecured, we heard the governor very clearly say that unsecured stress has abated. Should we expect retail to drive the growth? And then therefore, what will be the retail growth, the overall growth, and within that, the unsecured retail portion as well?
So we have given a guidance of 12% for the current financial year, and the system generally 1 or 2% less than SBI. This is a typical the way we look at the industry. But if retail picks up the way we expect now, maybe we will be in the 13% range, and the industry will also push towards 12% range is what I expect. As far as your unsecured personal loan question is concerned, as I mentioned right in the beginning, it's not only the stress in the unsecured loan seems to be better off. We have not seen, of course, our portfolio is completely different from the industry portfolio, but we also understand from the industry that the large pain on the unsecured loans is no more there, which also gives the confidence that a combination of the softening interest rates and the consumption drive will bring back the unsecured personal loan growth rates, because we almost hit the bottom now on the unsecured personal loan growth rate at the industry level, and it is only probably going to go up.
So if overall growth is at 13%, courtesy the pickup in retail, I'm just trying to understand the number. At what rate do you expect system-wide unsecured portfolios to grow at now?
I don't have that number, Surabhi. I won't like to hazard a guess now at this juncture.
Okay. That's a fair point, sir. Thank you very much for squeezing out time for us. And I think the chairman has given us a very important way to look at bank margins. We are going to see a fairly important cut, because every loan is going to be 0.5 percentage point lower in terms of return, because I think they have an external benchmark linked loan book of nearly 30% or 27% or thereabouts. So all those loans get cheaper immediately. By the time it works its way to deposits, it will take a little while, but not very long because of the generous liquidity. And then the cost of funds even falls faster by the time you come to September, October, November because of the CRR cut. And therefore, there is a U-shaped recovery in margins.
Margins will be U-shaped this year.
You know,
I think that's the headline he's giving us.
From a very consumer point of view, a friend of mine was telling me he banks with SBI, he's got a loan. I don't know, Mr. Sethi is still listening, but he was saying that every time there's a rate cut or a rate hike, actually it's in terms of rate cut, right? He says that, well, you know, he's got to reach out to the bank and ask them, can you please give me the lower rate? Otherwise, the rate doesn't. I don't think it's true for most. I don't know why it is, but I think you have to tell them to.
Especially home loans. I hear that all the time on Let's Talk Money as well. Yeah, you have to call up and say, if you don't cut, I'm moving to a different bank.
If you forget, you pay the higher rate for 6 months, and then you know. So anyway, I don't think it's a SBI specific thing. It's just an industry practice, I guess. But that is how things are. Well, I think another important voice, right, is Keki Mistry. Basically he's praised rate cuts from the RBI, banking sector veteran, former vice chairman and CEO of HDFC, saying that the central bank has done more front-loading this time only to inject growth back into the system. Excerpts out of that conversation with my colleague Shireen.
My personal view was that it would be a 25 basis points cut. But I think there's been more front-loading that has happened in the rate reduction, largely to fuel the growth back into the system. We had seen a little bit of a slowdown last year. We started seeing a big pickup in consumer behavior in the last 3 months or so, and this will fuel that growth further. You know, last year our GDP would have grown by, let's say, 6.5%. And we would say 6.5% is low compared to the 8.2 or the subsequently reported 9.2 of the previous year. But 6.5 still makes us the largest and the fastest growing economy in the world. So what are we talking about? But whatever little slowdown happened last year, to my mind, will change completely with this new reduction in rate. It's a big benefit for banks because the amount of money that we were putting with RBI where they were not getting any return, that amount will reduce. And if that amount reduces, obviously they can lend that money to the public at a higher rate. So the profitability of banks increases when CRR is cut. Interest rates being cut doesn't make so much of a difference because you have to pass the benefit back to customers. So, and the cost reduction may come a little over a period of time. The passing on of the interest rate cut is immediate. But the CRR is a huge, huge benefit for banks. So this will fuel growth. And we saw the growth coming back last quarter, where I think the growth was around 7.4%. And to my mind, this 50 basis points cut and the CRR cut is the confidence RBI has on inflation.
7, 8.
Okay, welcome back. Rajesh Bhatia is with us now. Rajesh, good to have you with us here. I don't know if you heard the conversation with the SBI chairman, but what's the thing to do? On the back of this rate cut, what would you buy?
Yeah, I think, the last two interviews were really very informative for your viewers. I think they laid out, Mr. Sethi of SBI just laid out the fact that the growth, which was a challenge, is something that they will address by increasing their loan book. And I think that's great for the stock markets as well. And I think, as Mr. Misty also said, the slowdown that we were witnessing in the last year is also getting addressed. Look, I think the challenge for the market was the slowdown in earnings, which was really by way of slowdown in GDP, because the government expenditure, which was really the one which was driving growth in India, was ebbing because we had to control our fiscal deficit. The other components of GDP were not firing. Fortunately, we have a very good deflationary environment. I would say inflation is very benign across several parameters, and that has given us tremendous monetary policy leverage to jumpstart growth. And I think the RBI governor has been courageous enough to go a 50 basis point plus a CRR cut to jumpstart growth. And when we talk to banks, they say that they are ready to lend again in the retail category. So this is going to accelerate growth, which is great for earnings and great for the stock markets. Left to our own devices, I would not be surprised if India goes to a new high. As far as your sector call is concerned, of course, look, I think the immediate beneficiaries of the interest rate cut are NBFCs. You have seen this is a very strong market. Look at how real estate, capital market plays, engineering companies have bounced back. As an aside, I would say it's probably automobile companies also, which have not participated so far, could also be beneficiaries as you move forward.
So incremental money, when you have to put it to work at this juncture, it would be NBFCs and auto?
So my incremental money has gone into NBFCs. It has gone into auto. It did go into quick commerce companies, and I bought some public sector banks. So that is really where my incremental money has gone. I rue the fact that I have not bought enough real estate or capital marketplace, but I think those are also sectors which can do well as you move forward, given what has happened.
You want to name any names, especially in NBFCs, Rajesh?
You know the challenges that we face. But I have added a gold finance company where a private equity major has taken a stake because it was available at a one-time price to book multiple. So that is something that I've added as far as NBFC is concerned. Of course, we have other NBFCs as well. We continue to like the fast-growing NBFC, which had become extremely expensive, only to become slightly more cheaper over the years as the price consolidated. We think it's catering to the right consumer segment, and it can kind of continue to grow as you move forward. So that's another large holding of NBFC that we have.
Real estate was a missed opportunity in some way. That's what you said. Now, would you look to add to real estate, or it's too late?
So my money incrementally is not going to real estate. Honestly, like I said, it was a missed opportunity. But when we speak to real estate companies, they are very excited about their pre-sales that they are witnessing. We asked them about whether they are seeing any slowdown given the stock market decline, etc. They were, quite affirmative that they are not seeing any slowdown. So even though they are hearing of an economic slowdown and a stock market slowdown, they are not seeing any pre-sales slowdown. And given this boost that you're going to get from for the economy, I think it's going to be a sector which is going to remain elevated. But for me, my margin of safety is a little low as far as real estate companies are concerned.
Yeah, no, absolutely. The other one is defense sector. By the way, the defense index, we've forgotten about it. It's down. The index is down after a huge amount of outperformance. Do you own anything here, Rajesh?
Yeah.
And the question is it, are these buyable now at these levels?
So again, I own only the frontline companies. But I can tell you, we were in a defense conference, and the kind of visibility that these companies are talking about, growth rates, etc., they seem to be full for a 5 or 10 year kind of a period. They kind of are alluding to the fact that they can actually grow for a very long period of time. But I think you've kind of hit the nail on the head. Are these at valuations which are comfortable? But look, I think that's a challenge for our equity market. There's just too much money chasing these growth stories. I mean, look, I've been to like 5 or 6 conferences in the last month or so. When you talk to electronic manufacturing companies, engineering companies, right, defense companies, the confidence for growth rate for 5 or 10 years is incredibly high. But these stocks are also not cheap. So that's really the challenge that we have. So India is in a very good spot. The risk will be only global. Our macros are very strong, and I think we are again poised to accelerate as we move forward.
No, absolutely. Another sector, Rajesh, like defense, where, you're asking the question, what's going on with the market caps, which have ballooned, right, is rail. And we're going to focus on that. Nimesh actually is now joining us. Nimesh is going to talk about, not rail now, but rail later in about 30 minutes time on Editor's Roundtable. Nimesh, but for now, what's the chatter? What are you picking up? What's the mood like?
Well, Prashant, it's all about RBI policy, right? And we've seen a big rally in the financial stocks. So the Bank Nifty is up 1.5%. The top gainers in the FNO are all part of the financial names, whether it's NBFCs or private banks. So actually, it's come as a big surprise. The whole policy was much more than what the street was anticipating, especially in the CRR. Nobody was anticipating such a big cut coming in. So that's been a big talking point in the daily rooms as well. And we've seen a reaction across the financials and rate sensitive. So I spoke about buying interest in the bank names and small private banks and NBFCs. Even the real estate, which was seeing a bit of profit booking yesterday, have again seen a big rally today. So all the real estate stocks are buzzing in trade and on large volumes as well. I guess from a technical point of view, 24,950 is the level on a closing basis to watch out for. If that's the case today, you might see further short covering rally in the days to come. So clearly, the RBI policy was the center stage today and has led to a big rally across the financial names.
What are you picking up in terms of specific stocks, Nimesh?
So the first stock on my list today, Prashant, is Ramkrishna Forging. That stock is buzzing in trade, up 10% for a couple of reasons. One, I understand there was a selling going on from a domestic mutual fund. That seems to be largely over. So supply is gone. And also the fact that the promoters, earlier this week announced putting in money at 2,100 rupees per share. The question mark there was on the warrant by when they will convert. the sense I'm getting from the investors or some of the buy side fund managers is that maybe that money will come much before the 18 months of the warrant period. So I guess that's also a bit of the reason why you're seeing a bit of traction in that name today. So that's the first stock. Second stock is Azad Engineering, which we highlighted a large block till in the morning trade, nearly 8% equity got changed hands. Again, I understand the promoter entity was a seller in today's block, and that's the reason why that stock is under pressure, because the entire deal happened at a much discount. The third name is ITC. This is going to be interesting. Well, the stock has been consolidating off late. I understand some couple of large, global FIs have bought also ITC in the last few weeks. But for ITC, the sense I'm taking is there could be a corporate development very soon, and that is potentially an inorganic move by the company in the foods business. So that's the buzz as far as ITC is concerned. And the last one is Elecon Engineering. Again, something I ended up putting out at least one stock where there is a large block coming in, and the next could be in Elecon Engineering. So while the stock has been consolidating, the sense is that could be a large block coming in Elecon very soon.
Swiggy, and there's the other one, right, which has been moving around. So RK Forgings is, of course, is the biggest volume-led gainer, by the way, right now. Azad Engineering, Elecon, and ITC are some of the names which Nimesh is highlighting. We'll keep an eye on these stocks. Well, we'll take a break here, but as we do that, let's just sort of revisit that story, which is, of course, the big talking point globally, the fight between President Trump and Elon Musk. The question I asked Leif Eskesen, chief economist at CLSA, is this. Can this fight lead to a toning down of the trade war rhetoric? Can this actually, at the margin, be a net positive in that regard? Listen and take that break. See you on the other side.
The more voices you have from corporate titans, right, that are pushing back at this sort of more aggressive tariff strategy, right, and a warning about the broader macroeconomic implications, but also the sector implications of these tariffs, right? The more people you have from that side of the spectrum talking out against that, it could, on the margin, as I said, soften the stance of the Trump administration in their negotiations with other parties, right? But I also think the sort of, should we say, the tariff strategy as an ideology runs deep in the Republican Party with Trump and with other advisors as well, right? So I don't think it's going to lead to an U-turn on that front, but maybe a somewhat more, should we say, constructive dialogue in the ongoing negotiations with other trading partners, right? So again, on the margin, it could soften the stance a little bit, maybe move us on the margin a bit more forward on some of these trade negotiations, right? But again, it's not going to stop them. It's not going to reverse them, but it could sort of add a little bit of reality check to the ongoing debates.
Welcome back. We're on the final leg of Closing Bell for today and for this week. And we have Mayuresh Joshi joining in with some ideas. Mayuresh, I was just looking at the tally for the week, and what a stupendous week it's been, right? Not only is the index practically back at the top of the trading range, but look at the individual plays. I mean, the capital markets, Nifty capital markets index is up 9%. Real estate stocks have done so well. And then, of course, you have the RBI bazooka. Okay, let me ask you this. Give us one or two stock names. If you are to play this cycle, this monetary easing cycle, give us a name. It could be a real estate stock. It could be a bank. It could be an NBFC, gold financing company. What would you go with?
Afternoon, Surbi. No, again, I think a basic tenet, I think with the cut that we've seen and the CRR cut as well, the expectation that gets broadly laid out, if you go back in history, is that corporate earnings might actually improve by 200 to 250 bips. So you might actually see a bump up of a couple of percentage points in terms of forward-looking numbers. So I think that's going to be a huge positive in terms of how the market looks at the micro earnings. Having said that, I think the expectation largely with the rate cuts that have probably come through is that financials as a space should continue doing well. And therefore, I think within the larger names, larger NBFCs, Shriram Finance is something that our belief is might still continue doing well. I think 2-3 reasons. One, I think in terms of the overall book structure of Shriram Finance, I think extremely well diversified as we speak, both in terms of the borrowing mix that it probably has, and also in terms of the lending profile. And that will give it the ammunition with the rate cut that has probably happened in terms of expanding its balance sheet quite significantly with very, very superior capital adequacy ratios that Shriram Finance has. The second element in terms of the unsecured book, because there is some sections of the street that believe that with the kind of rate cut that has happened and the impetus given to lending, will that mean that there might be some exaggerated lending happening specifically on the unsecured side, and therefore some element of stress building up happening if credit underwriting is not completely covered up. I think Shriram Finance also has that liberty because they have only 4.5% in terms of personal loans and secured loans to a large extent. And therefore, I think the balance sheet growth can be quite substantial for a leadership stock like Shriram Finance within the NBFC space. The rating, rankings, institutional holding are all top class. Again, a clear disclaimer, we own this stock both in our local and our global portfolios and continue to remain extremely positive on that. The second element, obviously, in terms of rate sensitives, is going to be are going to be your real estate and real estate ancillary stocks to a large extent, and therefore, I think the entire cycle that one keeps speaking about in terms of how the real estate inventory is moving, how pre-sales velocity are expected to take place, the asset-light model that real estate developers are undertaking at this juncture with taking minimal leverage in terms of their balance sheet exposure as well. Our own sense is that Prestige Estates has hardly done anything compared to the rest of the market as we speak. The expectation, if you probably look at the management transcript, in terms of how numbers might actually stack up for FY26, how numbers might actually stack up for FY27, might actually be far better compared to what they've delivered in the last year. And expectations in terms of analysts are probably pegging out. Again, a diversified model in terms of residential, commercial, and the annuity part of the business. And they've got a huge pipeline. So as that gets monetized, a large part of the cash flows will start coming through in the next few quarters. And comparatively, I think the underperformance has been stark compared to other players. So I think a couple of stocks that we have.
Okay, by the way, I think we'll just flash that news in the next couple of seconds on our screen. It's finally happening. Starlink is coming to India. Our colleague Ashmit is reporting this, that the DoT has issued that license to Starlink to set up SATCOM operations in India. It's been in the works for a long, long time. A lot of back and forth about what that will mean for incumbent operators, but finally it seems that this is going to take place. The third operator after OneWeb and, of course, Jio to get that license. So on a very interesting day when Mr. Musk has had other things on his mind, he does get access to one of the world's fastest growing markets, right? At least it's something positive while he battles other issues back home.
Well, let's see if there's a tweet or not, right, acknowledging it. But anyway, we'll take a quick commercial break here. There's about 5 minutes to go for close. Stay tuned.
Welcome back. Closing exactly at the 25,000 mark with a 250-point bump up, 1%.